We open today's coverage with a structural story that reaches far beyond any single earnings report or Fed decision, a generational reckoning with the American dream itself. Economists are now warning that Gen Z may become the first cohort in living memory where the majority cannot achieve homeownership or meaningful wealth accumulation. That is not a political talking point. It is a macro signal with direct implications for housing demand, consumer spending, and long-run GDP growth. The S&P 500 is holding strong this morning with solid gains, but beneath that headline strength, the demographic foundation of the consumer economy is quietly cracking. The core diagnosis is a compounding affordability crisis driven by three reinforcing pressures: housing costs that have outpaced wage growth for over a decade, student debt burdens that constrain household balance sheets before any asset accumulation begins, and a shrinking pipeline of intergenerational wealth transfer reaching younger cohorts. Economists tracking first-time homebuyer age trends and median home price-to-income ratios describe this as a structural break, not a cyclical soft patch. The 10-year Treasury yield sits at 4.38% today, meaning mortgage financing remains expensive at the margin, compounding the affordability math for any Gen Z buyer attempting to enter the market right now. Here is why this story deserves macro-level attention rather than just sociological commentary. Homeownership has historically been the primary mechanism through which middle-class Americans build wealth, through equity appreciation, forced savings, and leveraged asset exposure. When an entire generation delays or forgoes that on-ramp, you remove a major transmission channel for consumer net worth growth. That directly suppresses discretionary spending over a decade-long horizon, because renters have lower net worth and spend differently than homeowners. Current volatility measures signal complacency, but demographic headwinds of this magnitude rarely register until they collide with an earnings cycle or a credit event. The most directly exposed names are homebuilders. XHB, the homebuilder ETF, Lenner, and RYL all face a structural demand headwind if Gen Z delays household formation at scale. Consumer discretionary via consumer discretionary is the second pressure point. Amazon, Best Buy, and Target depend on younger cohorts cycling into big-ticket purchases that come with homeownership. On the defensive side, healthcare stands to benefit as capital rotates away from growth-sensitive sectors. Credit card issuers face longer-dated credit quality risk as debt-burdened younger consumers carry elevated utilization ratios. Gold futures and Treasury compression in the 10-year serve as barometers for how deeply this narrative penetrates institutional risk positioning. Traders should monitor the 10-year yield at 4.38% as the clearest real-time signal. If growth narratives deteriorate meaningfully, you would expect that yield to compress as bond demand builds on a flight-to-safety rotation. For housing specifically, watch XHB and Lenner for any break toward 52-week lows on sentiment-driven selling, particularly if housing affordability data or household formation reports disappoint. The Russell 2000 via the Russell 2000 is already underperforming today, which is consistent with risk-off pressure on smaller, domestically focused names more sensitive to consumer spending cycles. Any policy response, student debt relief expansion, housing subsidy legislation, becomes a swing catalyst that could meaningfully alter the trajectory for home builders and discretionary names. The actionable takeaway here is that this is not a one-day trade. It is a multi-year structural undercurrent that rewards positioning in defensive sectors like healthcare and investment-grade bonds while adding caution to homebuilder and consumer discretionary overweights. When the media and policymaker narrative around generational affordability reaches critical mass, the sentiment shock to XHB, Lenner, and consumer discretionary can be sharp even if the fundamental deterioration is gradual. Monitor the 10-year yield at 4.38% as your early warning gauge. That's the full picture on Gen Z and the structural erosion of the American dream. Coming up next, a macro development that is moving money across global bond markets right now. Turning now from equity markets to a geopolitical shockwave hitting the energy complex. Washington has just issued sweeping waivers on Iranian oil sanctions, effectively unlocking billions in revenue for Tehran as diplomatic negotiations toward a broader peace deal accelerate. This is not a minor carve-out or a narrow humanitarian exemption. This is a wholesale shift in U.S. sanctions architecture that reopens Iranian crude to global markets. W&T offshore is holding at $70 a barrel, up 1.1%, while Brent trades at $73.18, up 1.65%. The modest price reaction tells a story in itself. Markets had partially front-run this outcome, and the real debate now is what happens next to supply. The U.S. administration issued what analysts are calling sweeping, broad-based waivers, not the narrow, time-limited exemptions seen in prior diplomatic cycles. These waivers effectively permit Iranian crude to flow into global markets without triggering secondary sanctions on buyers, a mechanism that had choked off Tehran's oil export capacity for years. The prior consensus on Wall Street was clear. Sanctions relief would only materialize alongside a comprehensive, verified nuclear agreement. Instead, Washington moved unilaterally, signaling that back-channel negotiations are progressing far faster than consensus anticipated. Energy traders who had been hedging against supply disruptions are now reassessing positions across the entire crude complex, from W&T offshore at $70 to Brent at $73.18. The real driver here is not the price of oil today. It's the repricing of geopolitical risk premium that has been embedded in energy markets for years. Iranian crude has the potential to add substantial incremental barrels to global supply, and even the credible prospect of that flow reaching buyers changes how traders structure positions in W&T offshore and Brent. Beyond oil, this is a disinflationary signal. Lower energy input costs reduce producer price pressure across industrials, transports, and consumer goods, directly supporting the equity rally we're seeing, with the S&P 500 at the 7,363 level on the S&P 500 and the Nasdaq 100 at 28,556 on the Nasdaq 100. The VIX sitting at 18.18, down 1.25% today, is precisely the market telling you tail risk is being unwound in real time. Let's name the tickers directly exposed. The energy sector, the Energy Select Sector ETF, faces a medium-term structural headwind if Iranian barrels hit the market at scale, compressing the margins that have sustained the sector's outperformance. Chevron and ConocoPhillips, both high-quality integrated producers with significant leverage to oil price, are the most direct casualties of a sustained supply increase. Marathon Petroleum, the refiner, faces a more nuanced picture. Cheaper crude input is constructive, but margin compression from lower crack spreads is a real risk. On the beneficiary side, the Nasdaq 100 at 28,556 wins as stagflation fears recede, and consumer discretionary names in consumer discretionary gain from lower energy pass-through costs. Defense contractors like Lockheed Martin, RTX, and Northrop Grumman see geopolitical premium compress, though long-cycle budget anchors provide a floor. The single most important technical and fundamental level to monitor is $70 on W&T offshore crude. That is both psychological support and the line where energy equity earnings models begin to deteriorate materially. Brent at $73.18 is testing resistance. A sustained break lower would accelerate the risk-off rotation out of the energy sector. Watch the 10-year Treasury yield, currently at 4.38% and creeping higher by 0.09% today. Bond markets are not yet pricing a deflationary oil shock, which means inflation expectations remain anchored. The VIX at 18.18 is your tail risk thermometer. A move back toward 20 signals the market is hedging a political reversal of these waivers, which remains the primary downside scenario if domestic opposition to Iran engagement intensifies in Washington. Here is the actionable bottom line. Iran's sanctions relief is a net bullish catalyst for broad equities and a disinflationary tailwind for bonds, if it holds. The playbook is straightforward. Buy dips in the S&P 500 and the Nasdaq 100 on any geopolitical setback. Avoid crowded long positions in Chevron, ConocoPhillips, and the energy sector until the supply picture clarifies, and use the VIX at 18.18 as your early warning system for political reversal risk. Gold at $4,060.70, off 0.4% today, confirms safe haven demand is fading. That's constructive for risk assets. The DXY at 101.26 is barely moving, suggesting currency markets see this as contained. Those are the two stories that matter most this Monday morning. Full breakdown is up. If this kind of depth is what you need to trade smarter, hit subscribe and turn on notifications. We publish every market day before the open, so you're never caught off guard.